it's important to have people that can navigate very treacherous waters when it comes up. I don't like that. That's when I thrive because I'm familiar with that.
Welcome to the Big Money Influencers Podcast. We talk with top influencers and experts to help you navigate and prosper in your business. It's all about creating wealth, legacy, and an online presence. Here's your host, Ceanne Livingston.
I'm talking to Michael O'Sullivan. He's going to drop some great nuggets with us about financial investing. Would you please tell me in a nutshell, tell the audience in a nutshell what you do?
I am a financial advisor. I work with high net worth clients and I build customized income portfolios for my clients. My background, though, is traditional. I was a trader for Morgan Stanley for 5 years during the dot-com bubble from 95 to 2000. And from there, I went and worked for a company called CBiz, where I was the manager of investment selection and oversight for 401k plans, for qualified plans. What that entailed was actually managing about $2 billion and about 150 plans, qualified plans. That is the genesis of how I got to where I am now. But I started with actually being a trader for Morgan Stanley back in the mid-90s, way back then. So
you love doing what you're doing?
I do. I love it. The thing that got me into it was I wanted to go to law school originally, but I didn't have I was more a numbers person, right? I like numbers and statistics because they're kind of like broad facts versus they can tell a story versus comprehension. Reading law is to me, it's very boring. I came in and right off the bat, and in 93 I was licensed, but 95, the dot-com bubble started. I didn't have much money back then, but I watched for 5 years as a trader exactly what happened, and I learned a lot about risk and reward, how people, manage their finances, how they make decisions, that process, and how they have this perception of how the market works and there's reality. So there's a lot of things you learn about that, going through those cycles, if you will.
What problem do you solve?
Great question. Well, if you remember back in 2000 when the dot-com bubble burst, right?
Absolutely,
so
yeah.
I at that point, I was working at a company as a trader, and we had massive layoffs, and I was really depressed. I was at the time, probably my early 30s. I'm like, what am I going to do? I got a phone call from a recruiter. Mike, I got a thing here for you, possibly really good for you. They're going to be the manager of fiduciary services. So what do I do there? What it was, though, was coming in their investment side is picking the funds and designing the investment lines for their qualified plans, for the 401k plans, right? So from about 2001 to 4, I worked there for about 4. This was a good time, market recovered. And from 2004 to 2008, the same thing, right? Everything's going fine. I'm like, this is great. And do you remember back in 2008, the big Great Recession, all that? I was good at what I did. I built a reputation for myself, and I thought, so we were managing about, at that time, this is a different firm, Sage Point Financial, about $500 million in assets. This was a combined of, let's say there was probably 100 401k plans, and maybe there was $5 million in each one. As a whole, I was in charge of building the funds that went into the plan, the investment lineup. So if you're a participant, you'd say, okay, I'm going to choose this, this, and this. So we would go out and we build these just 401k plans for companies, and we would educate participants, telling you to go in and make sure you invest in you. So what happened one day is you remember back then the housing crisis was crazy, right?
Oh, definitely. I was in real estate investing at the time.
Yeah, we had notifications. So tell people they can't get their money out. It was really crazy. It was nuts. And I'm like, God, this just seemed familiar 8 years ago. And so there's this one day I had to go out and at times I would do education meetings for the companies, right? So this is how I got here eventually. I went out there and I met with the HR person first to talk about our meeting. And she's really nice. And she said to me, she goes, you know what, Mike? And she wasn't blank. She says, I did everything you guys told me. I put money away, 10% every paycheck. I did the match, this and that. I did everything you guys told me to do. And she was 62 years old, and she had saved up to this one point $500,000 over 30 years. And she goes, today it's worth $350. What do I do now? And this is in the midst of all this panic, and I'm like, here's the answer. The truth was, I had no answer. I had no answer because I can't control the markets. Okay, so the markets are great for certain times of your life. However, so what I do now, the problem I solve is I show people how to invest to prevent that massive, what's called, there's two things. It's called sequence of returns. All that means is that when you go to retire, if you're pulling out of your funds, right, and the market goes down, if a massive drawdown, you could possibly run out of money in retirement. And we avoid that nasty 30% drop. Could it happen tomorrow? Maybe. Could it happen next year? I don't know. And nobody knows. Back in 2007, the biggest hedge fund manager said, oh, that's not going to happen. No one knows when it'll happen, right? But the problem is once you hit, for me, the age is 50, you're a little bit more, you don't have what I call mulligan years, where you can just blow, I'll take care of it. And when you lose that much money, you feel it, right? When I was 27, like 3 years, I'm 30, no big deal. What I did was I said, and literally that burned a hole in my soul. I felt, she wasn't blaming me, but she said, and she had a great point. She goes, what do I do now? I said, I don't, and I had to tell her. I went back and talked to her. I said, I don't have, and that because she was exposed to, here's where the crazy part. If you go listen to traditional investment advice, buy and hold, don't try to time the market, don't try to, right, which is fine, but don't sell at the lows, hang in there, right? It always comes back, which it does. However, she's at a point where she couldn't wait. If you lose 35% in 1 year, right? It takes you years just to get back to even, just to break even. Now, again, I'm not saying that the market's a bad thing, but you can't, she took a massive risk and wasn't even aware of it. And she wasn't really aware of it because we kept telling her, just don't stay the course. That's what the commercial says, what the literature says, because I won't get into the details why it is, but so I sat there and I go, God, I felt horrible because she started, and she asked a very valid question. So this is in 2008, 2009. I'm like, what am I going to do? I thought, and I stayed in the business, got out for a while. And I said, there's got to be a way. See, in that scenario, you're out of control. You can't manage that. My nephew, who's 15, okay, I have him in some funds for college. If he's got 50 years, I mean, it's like, we're not worried. So for him, it's like, but once you hit a point, these things happen, it takes control of your life, and it really hurts people. It hits them emotionally. I found a way to, if you're 10 years or less from retirement, that's what I call it, kind of, you got to start lighting the fuse and pull things in, right? So it's a way, there's 5 components. And what this is designed to do is to prevent people who are near retirement from having that massive drawdown, but still making attractive returns, which is hard to do because the people think, but most people only want to manage the return side. How does it make? What's the performance? What is the 5-year track record? I went and I created this thing that's called defined outcome investing. And there's 5 components. So is there any questions up to there? Is that?
Oh, you're good. You're good.
Okay. See how the reason why I got here, and I couldn't look people in the eye and say, hey, you know what? Just hang in there. Just stay the course. Number 1 is we don't buy anything that goes down. Stocks go like this, right? If it goes down, guess what? We don't buy it. Sounds crazy, right? In other words, it's not just annuity. It's not just so what it is, number 2, that's number 1. Warren Buffett said, the most important rule is don't lose your money. Rule number 2 is see number 1. But in the stock market, in that you can't control the ups and downs of it. So now rule number 2, or number 2 is that the terms of the investments are predefined. So for example, we will do our company real estate, energy, insurance deals so for example, my investors will have a 3-year real estate deal that pays 7% monthly payments, right? At the end of the 3 years, their principal comes back to them in whole. Those terms are defined up front. There's no so in other words, they can choose to have monthly interest paid to them every month, cash flow, or it can compound. But those terms have to be defined up front. We're not going to guess. Now, mind you, we're not going to earn 40% or oh my God, this is more, you're in control. and the terms of the deal are upfront. So every month you get paid 7%. It could be, a dividend payment. So that's number 2. But does that make sense? Versus, I hope it goes up this month. Number 3 is every deal we go into, every investment, we're contractually obligated if the company goes into bankruptcy. We have a partial, some are OCC filings, but every contract we're in, we're actually an owner of the assets as well too. Because I can't say that, hey, they're never going to go down. They could have problems, they could, but we're also owner of the assets as well too. That's number 3. Number 4, this is extremely important, okay? The reason why I'm good at this is because I spent the first 20 years of my life going through and doing what's called due diligence for investments, like forensics and hunting for fees. And most people will look at investments from a performance standpoint, where you really have to look at 3 things. And there's a performance, which is short, mid, long term, 1, 3, 5, 10 years. Performance, risk, which is volatility, and operations, who's running the show. So I will not look at a deal or a company that doesn't have at least a 5-year track record, preferably 10. And the reason why is we want to see if we're buying a real estate deal for cash flow, I want to see a 5-year record of payments being made every single month. And I ask for that. If they can't give it to me, I move on. If I get, hemming and hawing, you move on. Because the companies we work with, so for example, one vendor we work with, they've paid every single month for 10 years. Never missed one payment. That's what we want. Versus a startup that's not proven themselves, that hasn't passed, and certain things in the investments have to have certain loan to value percentages or ratios that make sense. This is where I can look at and say, nope, I don't want to do that, because I know that the parameters where things will blow up, from working through subprime markets, from working through portfolios and stuff and seeing what's in them. I say this again, I'm not be careful how I say it. Number 1, I have some money in cryptocurrencies. I don't know enough about it. What I do in this part, I'm really good at this part of it. The rest of the stuff, because I don't know crypto enough to tell you whether, and here's where our industry suffers a lot, is that if some people don't get a certain sector, they'll just trash it. I don't quite believe in Bitcoin. However, I realize I'm not fully educated. Okay, I'm not saying that I'm right, but for me to get into it, I did put like a really small amount into it. Haven't made anything substantial, but because it could, but like it's a kind of like fun money. I wouldn't put my whole portfolio in there. It's just not prudent. So the thing is, people will kind of look at, I've got kids I'm 52 by the way, that lecture me about how dumb I am not being more on Bitcoin. I'm like, okay. And you just let it go. Because the problem we have is people think of either this or they're that, or they're this or they're that. And most of the time, we can use different parts of these tools for our advantage versus A or B. But we don't want to have our investors, the key thing here, what this solves is, I have clients who have worked their whole professional lives, and they're like probably like 10 years older than me, but they've worked, and they said, I just can't have one of these massive, imagine you've got $1 million, all of a sudden you wake up as for $700,000.
Yeah, that's a hit.
But think about that. How would that make your relationships, your come home, you're like, and you can't control it, and you can't fix it because you're already there. So what I do is I help them to prevent ever being there in the first place. I'm actually in the process of, I want to patent the name of this, not because for me to be because I really believe in it, and it comes from, I don't know what you've done for your whole life. All I know is when you're in the weeds and you see people quote unquote blowing themselves up financially, time after time after time, it humbles you. And when I see people that I don't take it personally, like there are these, I say kids, like they're all of a sudden they've had a big hit in Bitcoin and they're philanthropists now. That's cool. I get it. You haven't humility or humbled yet. And at some point you do get that humility, you get that humbling effect, right? I mean, 2008, I thought the world was going to end. And it was really scary. Do you remember that back then? It's not. But here's the thing though, if I was completely negative, the next 12 years have been really good. But with that said, I don't know when the next correction's going to come. We've had 11 of them in the modern era. and they can be 30, 40, 50%. So very careful how I say this, but I'm just going to say it. You have to have a competent advisor, wherever you're working. And I'm not saying it just not like, if you haven't navigated volatility or an environment where you wake up and the market's down 20%. The question is the problem people do is they'll want to react then after it's happened. You should have everything positioned to where when that happens, you're okay.
Learn the secrets entrepreneurs can use to create wealth and legacy. Discover exactly how the top 1% are building financial success, wealth, and a legacy quickly in their business. These are the only secrets you need to create wealth and legacy when it comes to building your online presence. When you visit bigmoneyinfluencerlive.com, you will get free access to the exclusive Big Money Influencers Live business kit. It teaches proven secret strategies that successful entrepreneurs are using daily to create wealth and legacy in their business. Foolproof methods established business owners are using to live and build wealth and legacy. We know you're busy, so we have convenient audios, which include foolproof methods established business owners use to build wealth and legacy. Easy to follow binder notes. And if you're ready to 10x your online presence or ready to take your business online, you can book a call and discover how to get started. Visit bigmoneyinfluencerlive.com. That's bigmoneyinfluencerlive.com.
The question is the problem people do is they'll want to react then after it's happened. You should have everything positioned to where when that happens, you're okay. My Bitcoin money, if you will, I have speculations, but it's like 5-10% of everything I own. And the thing is, if I'm so good at that, that will grow on its own. But I don't want this to be my grocery money every year. It's important to have people that can navigate very treacherous waters when it comes up. That's when I don't like that. That's when I thrive because I'm familiar with that. So
one thing that I was having a conversation going back to the Bitcoin with another guest that he specializes in Bitcoin. And he basically said Bitcoin, it's kind of like the door opening. There's so much, the secrets behind the blockchain. There's just so much, but Bitcoin is the popular thing, but there's so much more to Bitcoin and in that whole industry of cryptocurrency. And, it's like I'm wanting to find a speaker to come on and talk about the blockchain.
Yeah, and that's a good point because, and see, again, I've had to learn that if I'm not, I always say, I'm not against Bitcoin, but I don't know. So I know there's blockchain, which is like the record. It's a clean record. And the currency is for anonymity. But what I don't understand, I don't go on this, is that, again, this is my limited information, is that as a currency, my debit card's just fine. Mm-hmm. People say, oh, but you don't have internet. The thing is, if someone steals it, I don't feel as though I'm missing out not being able to transact in Bitcoin. Now, I know I'm missing something, and I've asked people to tell me, and again, I'm not being sarcastic, I want to know. But it takes a lot of energy to do transactions. Mm-hmm. What I understand, I don't understand my point. I don't understand, forget the investment, right? Warren Buffett owns Gillette. The reason why, because people wake up and they shave every morning. I don't get, as a commodity yet, how it's so fantastic. My fear is that I think it's a great idea, but that governments will get too involved in it eventually. I could be wrong. I'm not trying to trash the idea. I'm just saying that governments will always, we can't have that happen, That's but I think it's definitely a fascinating.
My friend bought into Bitcoin
4
years ago, and I said, no, thank you. I didn't see it. And so I let it pass, and now she's a millionaire from Bitcoin. So
beautiful. I mean, it's and that's why I said, can I go back to 95? It's 95. They valued there were .coms. This is a weird, I'm going to get this, the date, either it was 2001 or 2000. There were $5 trillion worth of people's assets lost. It was also the largest year people coming online as internet users. There's an index called the SOX index. It's a semiconductor index. And companies would come out, they would IPO, and they go like this, and this, and it was crazy. Every stock was in a fast market. And they were valued on not on revenue, but it was called the eyeball test. how many people were watching and dying that way? In other words, when this thing, and there was Lycos, Alta Vista, Ask Jeeves, all these companies hadn't proven themselves. I remember when Yahoo IPO'd, when Google IPO'd. Yahoo was the stuff. First, it was Yahoo.
Mm-hmm.
And they had a model and stuff, but these other companies that weren't really revenue, but they had eyeballs, and they would get investors, and they'd go crazy. But what happened though, and about people don't talk about this much anymore. 2001 was a really difficult. There's a lot of money lost in those companies. That's why I say I'm not here to tell people don't get excited, but is don't. And I can tell you, like, it's yesterday. The largest, there was a hedge fund manager, Joseph Sassana. I can see the clip in my head right now. He said there's no inkling of a possibility that these derivatives could possibly lose a penny. This was like the guy who was running AIG's derivatives department, and he's like a smart guy. He was the guy that basically, and he didn't think it was possible to lose a dime. And you had the whole crisis. My point is, when we're making money, we're like, yes. It's like we look for news that supports our thesis.
Right.
Oh God. So anyway, I just do that as a suggestion to think about. So, but I'll be happy to get your listeners and attendees a nice PDF. And I know that was a lot of information at once, but my message, if it is just to, here, be careful, just to make sure that that whenever you go into anything that has volatility, that you're aware of that, and you learn about what you're investing in, how it works, and how don't just take I'm often surprised at how my peers just trust stuff. Like, they just go off and I'm not making fun of them, but I'm like, have you kicked the tires? Have you asked for financials? Do the guys that are getting, have they been doing it for 4 or 5 years yet? Do they have a track record? I don't know. Well, okay. Why don't you know? So it's like, ask those questions, What if Bitcoin went to $1 million? Great. What if it fell to 2? Just ask yourself, how much would that hurt me? Would it knock me out? And if the answer is yes, consider you're too much on the greed side. We always have greed, we have fear. We're kind of like, I guess that's about it for all I've got. So, but I appreciate you. I think this is a fantastic, phenomenal idea for people to learn about how to take their education knowledge and actually apply it to their life. So.
Yes, thank you. So one other question I have for you: what advice would you give to a beginner, somebody that wants to step into building wealth through finances like you?
Yeah, it can be any age, by the way. Like, we're living longer nowadays. So one thing I tell people is that I plan to live to at least 95. And because I love to teach, and it's like, investing is not as hard as people, but I have to be careful because I don't have I've been doing it for so long, I forget that jargon turns people off because it's presumptuous that someone that doesn't do this would know the jargon. It's not IQ. It's just, we turn people off though, for basis points, and we're like, it's not really that difficult. So my point is, I would find, is it someone wants to learn for their own portfolio, like a professional? What? Like, I would find someone to mentor you, really.
Okay.
Best thing I think is I was very fortunate on a couple of occasions that people that really took it under the wing, and they like it for some reason. No, I'm serious. And it was like some of the pension business. Really fortunate because he would just throw stuff at me to do, and I was like, I'd figure it out. But I had his guidance and support for questions, and I'd watch him present, and I'd hear these things over and over and over again. Back then, it was we were talking about fiduciary services. This is back in 2001, and you heard the word fiduciary. It's fiduciary. All that word really means is, if you are an advisor or a source, if you will, that helps people, that you act in their best interest. So we were talking about that, back but people will throw terms around that sound really cool or sound really like, can you actually build effective things that get results. And nowadays, can you do it? Most people's biggest fear right now, and I'll get to that kind of like we're at 0% interest rates, 0% interest rates, is they don't want to have their portfolio drop 30% in one day, or something like that. And they're afraid, they're terrified. But the last thing I'll say is too is there's more than just one way. Like you everybody talked about Wall Street, stocks and bonds and that. Like your own business is one way too, of course. Best way is your own business. There's tools and resources out there that don't do this crazy stuff, So but I would definitely go back to your question. It's a great question. I want to read this book. I'd say really commit. If you want to be a good investor, it's not like just commit to the process. If I want to be a good salesperson, a good presenter, it's a good, this guy who does it this way. They're all good, but find someone you can relate to that will mentor you and learn their process. And just
definitely have had my share of great mentors. Choose a mentor that's doing what you want to do and being successful at it for sure.
Yeah, like I left the corporate world I was there for 40, until I was 47. I went from the corporate world to where we did sales. We had all our employees lined up for us. I was presenting ideas, but like to do the marketing now, and we're in the group together where we do marketing. I've had to learn, and it's been challenging, growing a lot too. But things I wasn't even aware of, I had to learn. And we have the same mentor on that side, so I've been really fortunate in that regard.
So you talked about investing in business. How important is it to invest in your business when it comes to building wealth?
Oh, wow. Great question. We've heard your most important asset, which is very true. It's extremely important. It's important to understand like your personal finances first, to pay your bills on time, to have good insurances for yourself. It's all about, people really focus on like, and again, I get it, get this fantastic result, like performance, like one of this. I've had a couple in my life, nothing like, oh, he's now in the big Bahamas, like a couple of good investments that done really well. Nothing like we all do, right? I had, but the key though, which attributes most success comes to following a prudent process. Like, do you pay your bills on time? Do you put money away every quarter or whatever? Do you invest in your biggest asset is your own self? Are you insured properly if something happens to you? Do you have put away for a rainy day fund? Now, for me, it's important. Some people say, no, cash is trash. I don't believe that at all. So, and do you also invest in your business? Because right now, the person that mentors us is a big proponent. I agree. I had not really thought of that as much. We want to put our money into someone else's business when we do ourselves. What does it say about ourselves, right? So absolutely. Yeah. So I put certain percentage back into my business, of course. That's the best investment. And so absolutely.
Well, thank you, Michael, for being with us today. I really appreciate what you shared.
Awesome. Thank you so much.
To discover the secrets entrepreneurs are using to create wealth and legacy, visit bigmoneyinfluencerslive.com. And here's a big ask. If you love this podcast, will you take a minute to subscribe, review, and give us a 5-star rating? Be sure and share with your friends and family. And thank you for listening.